Look, it looks better now than then. I think we're closer to the $3,000 pounds, and I think a lot of things really come together at the moment. If gold doesn't rally now, then I'm not sure when it ever will. Actually, I think the fundamental backdrop looks actually quite good at the moment.
Yeah, I mean, the fundamentals here is just about what actually drives it from here. Yes, there's the complete sense of a safe haven status, etc. Is it just the rates decline as well that you see globally that might be at play? What are the key elements here that will drive it forward to, especially 3,000?
Yeah, I think there's a lot of things happening at the moment. I think the geopolitical uncertainty certainly helps. I think the rates is where it gets really interesting. So, because what you see at the moment is a bit like rates at the front of the yield curve come down, and the back is actually very well supported. And it's that back that we are looking out for, especially because in the past we always said it's a 10-year real rate that matters the most for the gold price. And what we've actually seen is a complete decorrelation there. So these days, lower 10-year real rates are bullish gold, but higher 10-year real rates do not have to be bearish gold. And that's partly because I think there is increasing concerns about government debt levels, particularly when it comes to the US elections. There is very little focus on fiscal consolidation coming through. When you're looking at fiscal deficits over the next few years, 6-7% potentially, there's a lot of government paper coming out. And I think that makes gold really attractive as a kind of a safe haven asset. It's almost the ultimate safe haven asset if there's a lot of concerns about the treasury market.
Michael, I love to see you, by the way. We're not going to argue about lithium this time around, I'm sure. But in terms of, I agree with you, by the way. I think we should be concerned about fiscal consolidation, about the vast amounts of debt levels globally. But the problem is, for people like myself, who I guess I would consider myself parsimonious, to say the least. I've always been worried about global debt levels. I've spent every quarter looking at these IIF debt figures, and I've been almost hiding under the desk somewhat. Why should I worry now more about the fiscal situation and the debt levels globally than I should have done in the last 5 to 10 years?
It's interesting that you say that, because we've been making that pitch for well over 3-4 years now. And I agree with you. Look, under the bonnet, people didn't really look. And so it always fell a little bit by the wayside. I think where it is really interesting now, when you're looking especially at the US, I think you have fiscal programs, the way it looks, that just keep adding to the debt. When you're looking at the overall debt levels in the next 3 years, you will have the highest potential debt level of the US relative to GDP. And the interesting bit, it's not just that. When you're then looking at all the spending commitments that we might see over the medium term through the energy transition, through demographics, and potentially through defense, not just in the US but globally, we are just piling an awful lot of spending and debt on. I think it's going to be very hard going forward to contain it, or much harder going forward to contain that. And I think this is where that bid for gold potentially comes through. I mean, we were at the LBMA conference last week, the Bullion Market Association conference, and we are talking to market participants, also the central banks there. It's clear that there is a lot of concern about the fiscal picture in the US. If you run your portfolio and you're very heavy on US Treasury and you see volatility and uncertainty around that increase, so you want to diversify. And I think this is also where that bid from central banks for gold at the moment is coming through.